Let me ask you a quick question. Have you ever Googled how much do I need to retire? And the number that comes up is something like 1.7 million because that's what the majority of Americans feel that they need to retire. But then in the back of your mind, you're like, is that unique enough for me? Like, what if my lifestyle requires more or less? What if my income streams give me a higher return than other people's income streams? It really is a question that's unique for each of us. And so today we're going to go through how to determine how much you need to retire and genuinely how much that is for you. If you don't know me, I'm Dre Griggs with Obsidian Wisdom. I help people who plan on retiring in the next 5 to 10 years, and I help people to minimize their fears and maximize their money for a great retirement lifestyle. So in today's video, what I'll do is we'll go through the 7 streams of income and how much someone can expect to need to have saved for retirement. Because when you ask the question, hey, how much do I need to have saved for retirement? It depends on the income streams that you have. So the first thing that we'll do, and I think is the important place to start, is to recognize that most of us start with earned income. We work, we get paid, and then we take that money and we have to save a certain amount of it in certain assets that we know will generate an income for the rest of our retirement life. And normally, the way that those assets work are you're going to invest in either real estate, the stock market, or your own personal business. That normally these are going to be the 3 asset classes that you will place your money in. And then, based on these asset classes, we know what the income streams that you receive are. The IRS says that they recognize 7 streams of income. Now, it's good to note that the numbers show that 65% of self made millionaires have at least 3 streams of income, starting with earned income as number one for most of us. In fact, when you look at the millionaires, if 1 out of 10 people are millionaires, there is a large percentage of them that own a business. And we'll talk about profits from a business, but a large percentage of them have high earning jobs. And so that could be a doctor, an engineer, a lawyer. We see teachers also through their pensions become millionaires in retirement. That's very common. That accountants as well, IT people, people in technology, that all these streams create lots of millionaires. Naturally, finance, the field that I'm in, also creates a significant amount of millionaires. So when you're looking at earned income, starting with that is a great place to start. But we recognize if I'm going to stop working, then my money has to work. And that's when you have to start investing your earned income in these 3 asset classes to have access to those additional streams of income. So, what we'll do is let's first start with real estate. So, if you're investing in real estate, then we know that you will receive rental income. One of the cool things about real estate is you get to leverage your money in a way where you need less money to control larger assets. And you're probably like, well, Dre, what does that mean in English? And I'm glad that you asked. In English, what we're saying is if I wanted to buy a house for $200,000, I don't need $200,000 to buy the house. I only need 20% of that. Now, I know there's little nuances and closings and different fees, but we're just simply saying high level, 20% is all I need. So if you look at that, then 20% means I actually only need $40,000. That if I have $40,000, I can purchase one house. And we normally will look at the rule of 1%, which simply says that I should be able to charge 1% of what that property is worth, and I can charge that in rent. So if I'm generating $2,000 every single month from one property, I now have that in my retirement. So I've only needed $40,000 to have control of $200,000 worth of an asset. If I then generate another $40,000, I could have another 200,000. And then we can have another $2,000. And you can see that that basically means that I had 40K here, 40K here, and 40K here, which totals 120K. So I invested 120K and I now control $600,000 worth of an asset. So the leverage that I receive in real estate allows my money to be worked in a more efficient way. Now, the goal for someone was like, hey, Dre, I want to have like $100,000 every single year for my retirement. I think that that would help me set up where I can go traveling and live my life. I can donate, do all these things. And if you take Social Security into consideration, and that on average is about $1,800 a month, So basically, what we're saying is if you take $100,000 and you divide that by 12, that gives you about $8,300. And so that means I basically need like $8,000 a month to be able to live off $100,000 a month. If I have these three assets, three properties, $6,000 a month, I now have the other 2,000 coming for Social Security. Boom, I have my $8,000 a month from three properties, $120,000. And that's very doable. Another benefit that I have with real estate is I get to increase that amount with inflation. People expect their rent to go up. And because people expect the rent to go up, I then can increase that and fund my retirement where I'm not just having $6,000 a month today, but I have the equivalent of that lifestyle in the future, which is a very nice income option for you. And so you can see that if I'm investing in real estate, the income that I need is much less. I only need to have $120,000 saved. Now, of course, we do need to have a portion that's set aside for maintenance. If you own and are renting, then if the AC breaks, that's on you to fix. When the carpet needs to be replaced, that is on you to fix. Now, maybe if they do something that's dumb, you can have them pay for it. But if it is a normal wear and tear, then that could be on you to replace. You also have to look at it from managing the property. Some people will say, I want to manage the property, no big deal. They call me, I fix it, I'm a handy person. Other people will say, I don't want anyone calling me. I want to set it and forget it. Well, then you have to pay someone to manage the property. So that would come off of the amount as well. Not to mention, we've only actually paid for 20% of these assets. That means we owe the other 80%. Another way of thinking of it is if we start early enough in retirement, I am giving myself the ability to pay for this asset with the income that's generated from the rental property. Or I could choose to take my earned income and continue to pay off my mortgage. And then I could take the rental income and pay off the mortgage with that. So now I have two income streams tackling the same assets, which is why you can see that three income streams for 65% of self-made millionaires, it just makes sense that if I'm now working and my money is also working, that is a great position for me to be in. Another income stream, and we will skip the stock market because technically you can get every income stream in the stock market. So we'll come back to that one next. But if you have your own business, it would be profits. So when you have profits from a business, the way that we normally think of that is I charge a certain amount. That's my revenue. I subtract the cost of me providing that service. That's my cost. My revenue minus my cost of goods gives me my profits. Now, the thing about calculating your profits and how much you need to have saved for retirement is interesting enough, you don't actually have to have the same large amount of money that we normally are thinking of. We're normally thinking of 1.7 million. That if you were to buy a business for $1.7 million, it is not to generate $100,000 a year. That business most likely is generating at least 500,000, maybe even $1 million a year, right? Like that would be very reasonable. If I sold my business for 1.7 million, then I'm probably generating at least $1 million for my business, $500,000 for my business. That is not 100,000 because there's multiples that we can charge for our business. That means that I have a couple of choices. One is I could just start the business where I take my earned income, I take a portion and I start a company. And if you wanted to sell t-shirts, well, that's like a little shirt press, the shirts that I would need and the sizes, and then whatever digital products I need to be able to design the shirts. And then whatever the shipping is, it's very reasonable to say, yeah, you could probably get that business started with $20,000. Probably. Well, if I'm able to get it started with $20,000 and then my business, I can sell these shirts for, I don't know, let's just say $100, just to make the math easy for me. You might be like, Dre, I don't know. Let's just say you have a nice shirt and they're going to pay $100. Well, if my goal is to get to that $8,300 every single month, as we mentioned, that means that I need to sell 83 of them. That if I sell 83 shirts, I have achieved $8,300 for that month. And then if I do that every single month, I know that I have $100,000 in retirement. And it maybe cost me $20,000 to get that business started. Let's be conservative and say it cost me $50,000 to get that business started. I'm still generating $100,000 every single year from that $20,000, $50,000 investment. Again, we're being very conservative. You and I both know you probably can start a short printing company for much less than that. But we're simply saying the math works. If you were able to think of a business where you could charge $1,000 per person, well, that could be a mastermind. That could be a course where you meet once a month and you go through the process to help them. One of the cool things about people who retire starting a business is they already know the skills that they have, the skills that they've been paid for over the life of their career are economically valuable. In other words, people are willing to give money for them because people paid you to do it as a job. So then people would pay for you to do it as a consultant in your own business because we already know people have economic value tied to that. They're willing to pay for it. So I could take some of my skill set and I put it into a course and I train people. I do once a month, things like that. Charging $1,000 is not crazy. Well, you get to move the decimal over. So while I need an 83 here, I would technically need 8.3 here. Really, we'll just say 8 or 9, right? Obviously, you're not going to have 0.3 of a sale, but you get the idea that if I move the decimal from 100 to 1000, so I move it over 1, I then get to shrink it on this side. So I move it to the left 1. And so that's what we did. We went from 100 bucks to 1000 bucks. We went from 83 units to 8.3 units, or just 9. So now I have my $9,000 a month. I have $1,000 product and I only need to sell 9 every single month to maintain my lifestyle. Now, if you are someone who has a skill that the value is clear, it's not impossible for your company to charge $10,000 per unit, and then you just have to do one sale every single year. And the way I describe it is it's about the value that you create. It's not the cost. You may be thinking, well, $10,000, Ray, who would ever do that? And I have things I charge $10,000 for because the value is there. So the value is 10 times what the cost is. Who would it take it? For example, if I said, hey, I have a Lamborghini, $10,000, are you interested? Most people are going to find $10,000. Why is that? Because we all know a Lamborghini is worth 10 times that. It's not even a question. I know for a fact I could sell this Lamborghini at least at $100,000. So that makes it a great value. It's not the price, it's the value. In entrepreneurship, I learned along the journey that the price is not really the issue. They don't see the value in it. And so if I'm sitting there with someone and I'm like, hey, look, if I put an investment strategy together that's going to generate you $100,000 every single year, would it be worth a tenth of that? Would it be worth 10,000? And just like the Lamborghini, I believe the answer is yes. And so you just have to simply find something that is 10 times the value of what you're charging. That's the way I see it. Now, there are scammers out there. When people are out there saying, oh, buy my course for 10 bucks and it will generate you $100,000, don't you in the back of your mind think, if it was true, would you give it away for $10? Right? Because that's what I think. I'm like, but why is it $30? Right? Like, why is that? And so I have found that not only if we know the value is there, that we pay for it, I find that if we are being charged it. So if someone, let's flip the story. If someone was to sell me a Lamborghini and they would say, hey, this Lamborghini is $1,000. I'm like, what's wrong with it? Is the engine missing? Right? Like maybe that's just me. I don't know. But I would be asking a lot of questions. I'm more skeptical because it's so low from what it's worth. And I'm like, is something like, is there interior stripped of it? Does it not work? Like what's wrong with the thing that you're giving it for $1,000? And so that's just me. Another one that some will consider, and is sort of in between the stock market and the business, is royalty income. And so the way royalty income works, there is a great story, a great example of this guy who invented the super soaker. He was a rocket scientist. He had sprayed himself with the water, and he immediately realized in that moment that the pressure was what caused the water to shoot stronger and splash him in the face. I'm like, okay, cool. But because he's a rocket scientist, he was able to create the technology, patent it, and then he thought, should I start a company? And he's like, no, I'm a rocket scientist. I like this. So what he did is he licensed the idea out to a toy company who then creates a toy and then mails him a check every single month. And he has made over $70 million from an idea in a company that he never had to start. Just the idea that he patented and then he licensed it out. That's royalty income. And you could do this with music on Spotify. You could do this with a book. So if you had a book, let's say you sold the book for $10. We already know that the way the math works is if the number gets larger, I go back or I decrease how much units I need. So the number gets smaller, I have to increase my units. So if I only need 83 units to get $100, That means I need 830 units at $10. Maybe I go to conferences and seminars and workshops and I put up books and vendors, or I have book signings, however that looks. If I charge $10 and then I make 830 sales, I have $8,300 that month and I have $100,000 a year. Now you could naturally increase and decrease the number accordingly. And maybe you write multiple books. Well, now that I have the books, people are buying more serious, and then the sales are a little bit easier. There are lots of ways to do this. Naturally, you can do it with music as well, and Spotify and different things. And the idea is I play the music, Spotify takes a percentage, and then I get the rest of it. That's my royalty. They do the work, they do the marketing, they put it up there, and then we go from there. Same with the book. If I have a publisher, then they keep a certain amount, and then I get a certain amount that every book sells. It could be all sorts of things. Disney license out their stuffed animals where they don't make all the stuffed animals in house. They simply find someone else who will produce it. They give them the license, they give them the right to create the stuffed animal. They get a certain amount, Disney gets a certain amount, and then everybody's happy. That's the idea of a royalty. I'm not 100% sure I want to start a full blown company. I have an idea that I believe will make money. Is there a company I could partner with where they have the infrastructure, they have everything in place, and then they get some, I get some, right? It's a partnership. And so that would be royalty income. If that's the case, how much would it cost for you to be able to write a book? Probably say relatively little. Maybe have to pay an editor here, maybe a publisher there, but the cost is relatively low, and then you can generate the income. With the music, maybe I have to pay for studio time. Maybe I have to pay for someone to clean up my songs. Maybe someone has to write the song for me. I don't know. But we would probably be able to get away with this again under $20,000. So the amount I need to save for retirement is much less. And then we haven't even talked about your lifestyle and how much you actually need. We're just simply using $100,000. So that way the math is kind of easy and we can just kind of keep working through these examples. But you can see that the amount I need changes depending on where my money is being generated, depending on where my money is saved and the income I'm generating. So then when you move on to the second half, so when you talk about the stock market, normally these are going to be the assets that most people are talking about when we're saying, oh, you need a lot of money. You need that 1.7 million. So what we're normally going to be talking about, let's first start with interest. So interest income is considered the safest form of income. There's not a lot of risk in interest income. I am giving you my money. I'm letting you borrow my money, and I am your creditor. It's no different than when you get a credit card. Visa is not on the hook for anything that you do with that money. They are not invested in you. They simply loaned you the money and you're supposed to pay them back with interest. That is this idea of interest income. So if you put your money in a savings account, the bank gives you interest at the end of each year because they took your money and they use it to make more money. So they're paying you for your money. They borrowed your money, right? So they borrowed it. When you look at the $38 trillion the United States has in debt, right? We're talking about treasuries, treasury bills, treasury notes, treasury bonds. Well, that is the government saying, I need money today to pay all of the bills that I have, and I'm not generating enough in tax revenue. So can you let me borrow some money today? I promise to pay you back with interest in the next 5 years. And so if they said, hey, look, it's a 5% rate, what that means is every time you give them $1,000, they will give you a 5% yield. So that is $50 every single year that they'll give you. And then however many years that is, and then ultimately what they'll do is they will give you back the money that they borrowed plus the last payment. So they'll give you back $1,050. That's if you have like a 5% yield. And so that's the treasury. The government's borrowing money from me. They pay me back with interest. That's a form of income. You could also have corporate bonds. And so that's corporate debt. Now, we're talking about corporate debt. Every corporation isn't the same. There are A-rated companies where they have great credit, and there are very risky companies out there. And so it's just like in the real world where if you buy a car, if someone has great credit, they may get a 0% interest rate to a 1% or 2%. If you have really bad credit, you may have to pay a 10% yield, a 10% interest rate, or you may be declined altogether. That would be the same with you. If you're going to give your money to someone, you should get compensated in a way that matches the risk that you're taking. If the company is a great investment, fine. They'll charge you 2% and you'll be fine with that. If the company is a little bit riskier, hopefully we're not talking about penny stocks, so that's just ridiculous. You should just decline that. But if they're a little bit riskier and they're willing to pay me 6%, then that may compensate me enough for my risk that it's now a good investment for me. Interest could also be the CDs, and interest could also be the money market accounts. All of these would be forms of income that we would consider interest income. Because interest income is the safest investment, there's not a lot of risk in there. The yield that I receive depends on the interest rates, and that depends on the market as a whole. Because of that, it would not be crazy to get like a 2% interest rate. And if I wanted $100,000 every single year and I'm going to get a 2% yield, that means that I need $5 million. If I am going to get a 4% yield, which is not crazy as the market changes, 4% is definitely a possibility as well. That normally will be somewhere around that 2 to 4%. When you're looking at the interest when they're at zero, when we're coming out of the Great Recession, you're getting like 1%. That was a really rough environment. But 2 to 4% is pretty normal. You would expect these to just kind of hover right around inflation, just a little bit below it, maybe slightly above it. So if I have a 4% yield, then I would take $100,000 and I'll divide that by 0.04. And that means that I would need $2.5 million. So if I have $2.5 million, 4% is going to be the yield, then I would expect to be paid in interest $100,000 every single year. If I have a 2% interest payment that I'm expecting, then I would expect to need $5 million to have $100,000 sent to me every single year. Now, if you're someone that's saying, well, Dre, that does not seem very efficient. That requires a lot of money from me, and I can handle a little bit of risk. So is there something in between that? And I'm glad that you asked. So the something in between that is what we would consider dividend income, and it's technically called investment income, but we often refer to it as dividend income. So if I have investment income, that means I'm going to be living off the income that my investments generate. I do not actually sell any of the assets. I don't sell my house. I don't sell my stocks. I don't sell my business. I just live off the income that those assets generate. And if you're someone who wants to live off the income, leave the assets, maybe you have generational wealth aspirations, the way this would work is normally the stock market gives you about a 2.5%. So we'll just say 2% because I already did the math. So that means you would need $5 million to be able to generate $100,000 a year with a 2% yield. That's a general dividend yield. And I'll put a link to a playlist where I go through in great detail a bunch of dividend investing strategies where we talk about all the pitfalls, the traps, and everything. Now, wouldn't it be crazy for me to find an 8% yield in something like a REIT, like a real estate investment trust? Remember, I mentioned how the stock market has access to all the streams of income. This is kind of what we're talking about here. So I can access rental income without having to own a property. I can get a REIT. So basically, you're a silent partner in a real estate firm, and they may own malls, they may own apartment complexes, they have really large real estate portfolios, and they open it up to you. They collect millions of dollars and they go buy these very large rental properties. And then they generate the income and they share about 80% of it with you. So an 8% yield, because of the savings that you receive from a tax perspective, requires them to give out 80% of the income. It's like a pass-through entity. It just means they don't hold on to it. It passes through to the people who own it, and you would be one of the owners. So 8% would not be crazy. So if I had an 8% yield, well, that means I only need $1,250,000. That now I went from a 2% yield of 5 million to now I only need 1.2 million. And if you have a 10% yield, you only need 1 million. You can see how this works. Now, a couple things to be cautious of, because what happens is people say, oh my gosh, the yield is so high. That just means I just need to find a high yield and I have a lower amount of retirement savings. That could cause you to fall into what we call a dividend trap. And there's two ways to just protect yourself. One of them is I should look at the payout ratio. The payout ratio tells me what percentage of the earnings per share is the dividend that's being paid out. And so normally if we have a payout ratio of about 50% to 75%, we normally feel pretty good about that, where they're basically saying, I generated an earnings per share of $2 and my dividend is $1. That's a 50% payout ratio. I'm paying out half of the dividend to you as a business owner, and then I'm keeping the other half to reinvest in the company. Most people are okay with that. You need money to reinvest in the company. That's how the company grows, and that's how I know you'll pay me a dividend for a very long time in the future. You will find some dividend payout ratios out there that are 100% to 150%. That is a red flag. And the reason that's a red flag is now we're saying that you generate $2 in earnings and you're paying out $2 in a dividend. How does the company grow? How does the company reinvest itself? How does the company last for the long term? That is some of the questions that I would have if you're paying out all of your earnings in the form of a dividend. There are some that will pay more than they earn. They'll take out debt to pay out the dividend because they're trying to trap you. They know if you're just looking at the number and you're like, well, 8%, if it's a 10%, if it's 20%, that means I need even less money. It's true, but how long will they pay the dividend out? And so normally we look at the payout ratio. The other thing that we look at is the dividend yield, as you just saw. So if I know that the average dividend yield is about 2%, I know that it's not crazy to find them at 5, 6, 7, 8%. I don't want to just chase the yield, but I do want to be mindful of the yield. That if I know what the yield is, I know how much I'm going to be paid out, and I know how much I need based off of that yield. And I need less money saved for retirement income, the higher the yield is. So I do want to be mindful of it, even though I'm not going to allow the tail to wag the dog. And that if I have a good dividend yield with a good dividend payout ratio, I normally feel good. Another thing that we look at is how many years they paid the dividends in a row. And so we call them dividend kings, dividend aristocrats. There's different ways to discuss them, but high level, what it means is you're a dividend king, you've paid a dividend for 50 years in a row. You're like, oh, wow, that's really good. Or maybe it's 25. But either way, you paid the dividend for multiple decades in a row. So we're like, this is not a fly-by-night operation. This is a very safe, successful company that has been paying dividends, and they'll probably keep paying dividends. And so that's the idea there, right? So I look for these companies that pay dividends for at least 10 years. And then I'm like, all right, now I'm not chasing a dividend yield. I have a company that's been paying them and will probably continue paying them. Because one withdrawal strategy that some people like is an income-based strategy. And that means I take my rental income. So I take my $2,000 a month from there. I take my dividend income and I take a portion from there. And then I have my interest income, and I don't ever sell the asset. I just live off of the income that they're generating. So I still have all my stocks. I'm just living off the dividends. I still have all my properties. I'm just living off the rental income. And then the interest is a little bit different. So that one doesn't quite fall into that example. But then your profits from a business does, where I'm still living off the income that my business generates, but I'm not selling the business. Now that leads us very nicely into number 7 in our final form of income, and that is going to be capital gains. So the way capital gains works is I have assets. We already mentioned I have 3 assets: real estate, stocks, or the business. If I hold those assets for 1 year plus 1 day, when I sell them, they won't be taxed as ordinary income. They'll be taxed at capital gains, which is a much more favorable tax rate. That's where we get the idea of Warren Buffett gets taxed less than his secretary. We're saying that he's living off of his capital gains, and because of that being a much more favorable tax rate, and his secretary is living off of earned income, and because that's the least favorable tax rate, we end up being able to save or be taxed less as a percentage, not as a dollar amount, but as a percentage. And so what you will do is you will sell your assets. So you could sell your real estate. You could sell your business. Or you could sell your stocks. And the idea here is I receive a certain amount of money from that sale. So let's say in our real estate, we had one of our properties. So it was $200,000 when we got it. We've been living off of that $2,000 a month. Life has been rainbows and skittles. And we just want to get rid of one of the properties. We just want to manage 2 of them. Over that time, the property's value has now increased to $500K. So I have what's called a cost basis, which means how much I pay for a property of $200,000, and then I will have $500,000 that I'll generate. Because I held the property for at least a year to date, it will be considered capital gains. So with my capital gains, what I will do is I now have the $500,000 that will be taxed at a much more favorable rate, minus my cost basis from a tax perspective. And so I take that income and I can do anything I want with it. I can still have my 2 properties that are generating me $4,000 a month, I can then have my dividend where I will take $250,000 or I take the whole $500,000 and I will go buy dividend investments. Or I can take that money and I can go purchase someone else's business. So I can take the $500,000 from real estate, I could purchase a business and I have that stream of income. I can purchase the dividends. You have lots of choices. You could technically say, I will take the $500,000, I'll buy a business for $250 and I'll buy dividends for $250. That you have that option that is available. And because you have that option available, you then find that I can see why 65% of self-made millionaires have at least 3 streams of income. Because when I have that additional money, I have more flexibility on how I invest the money. And because I'm able to now create these multiple streams of income, you can see that I don't actually need to have that much saved. That sure, if my only plan is to invest in the stock market, then yes, I would need that 1.7 million that you sort of look at. But if I was going to invest in real estate, if I was going to invest in a business, if I was going to focus on these other income streams, then I don't need to have as much saved because it's not just me working, it's my money working. Now, if this got the wheels turning for you, where you're sitting there and you're saying, oh, I see how this could work. I see how this could help me in my retirement. I want to invite you to our Worry Free Wednesday. Every single Wednesday, we get together and I go over the 5 hidden risks to a wealthy retirement. And I give you 3 frameworks that I use with my clients to ensure that they don't run out of money and they don't have any of those concerns with their own retirement. I invite you to come. It's every single Wednesday. I'll put a link in the show notes, or you can go to obsidianwisdom.com and you'll see the little button that says, I want a worry-free retirement. Click that button, come to the next workshop. I'll answer your questions and I'll give as much value as I can. As always, I'm thankful for our time together. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealth of retirement. Until next time, stay safe and enjoy life.